Hey there, Dave Keller here with Market Misbehavior. The new Dow Theory looks at the S&P 500 and Nasdaq Composite. One of those two indexes has made a new high for the year. The other one has not. What does that mean for the broad market environment? So Charles Dow, back in the early 1900s, late 1800s, wrote a series of essays talking about really the foundation of modern technical analysis. And one of the things he's really credited with is the idea of looking at indexes, right? Of taking groups of stocks, putting them into indexes, and popularizing this idea of measuring the strength or weakness in the overall economic conditions by looking at the performance of those stock indexes. One of the things we now call Dow Theory looks at two different indexes or two different markets and see if they agree or not. If they agree, conditions are good. If they don't, maybe conditions are not quite so good. Today we're going to look at the original Dow Theory, look at a newer version, which I call New Dow Theory, what it's telling us about the market right now. Before we get there, if you like this thinking about technical analysis, market history, and investor psychology, go ahead and subscribe to my channel, won't you? Also, give the video a thumbs up if you appreciate it. We'd very much appreciate that back. Put a comment below. What do you see next for the S&P 500? The next 5% move higher or lower from the current levels, and why? Now, let's look at the original Dow Theory, or as close to the original Dow Theory as we can do here in 2023. Charles Dow really thought about the Dow Industrials and the Dow Railroads, which are now sort of turned into the Dow Transports a number of years ago. So the idea was you have the Industrials, meaning the producers of goods, the Dow Transports, meaning the distributors of goods. And if the producers of goods and the distributors of goods are both doing well, the idea is the economy is strong because we're producing a lot of goods and people are buying them because distribution channels are fairly active. If they are both struggling, that means economic conditions are clearly bad because we're producing less stuff and we're distributing less of that stuff. But the really interesting one is where there's a non-confirmation, where one of them breaks out and the other one does not. Because what that will often indicate is there's something maybe a little underneath the hood. Things appear okay because one of those is going up, but there's something wrong with part of that. Either the producers or the distributors are telling you something's a little off. Now, the Dow Industrials and Dow Transports, we can still do that same methodology, pretty similar to what Charles Dow created. Here's the problem, though. When Charles Dow created this, the Dow Industrials was a small group. It was about 15 stocks at the time of big industrial names. Think of like GE type of companies. And then the distributors were the railroads, which are the ones that were actually literally able to get the goods out to the consumers. Now the Dow Industrials, the modern Dow 30, includes things like big banks, which aren't really producers of anything, arguably, but certainly not physical goods that consumers are necessarily buying. And as we've rotated to much more of a service-oriented economy from an industrial economy, the meaning of the Dow Industrials, the Dow 30, a little less important. Transports tends to include trucking companies, railroads, and airlines. And while those are all in general distributors of goods, it doesn't include things like Walmart and Amazon and Target, some of those big conglomerate companies that actually sell retail goods but also have a built-in distribution network as part of it. So it's become less and less of an accurate representation of what I think Charles Dow was trying to accomplish. So here's the Dow Industrials, the Dow Transports. There have been some comments that I've heard in February because the Dow Transports did make a new high for the year, but the Dow Industrials did not. While that is very much a bearish non-confirmation from traditional Dow theory, I think there's a less importance to that signal than if we use what we call the new Dow theory. What I'm doing here is basically adapting what I think was the essence or the inspiration of Charles Dow's idea of looking at the main pillars of the economy and modernizing that to our modern economy. I'm looking at the S&P 500 essentially representing the old economy and the Nasdaq Composite representing the new economy. Now, is there an overlap between these two? Absolutely. There are names that are considered both in the S&P and the Nasdaq Composite, but I would say in terms of the weightings of these indexes, the S&P includes a lot more of the traditional sort of industrial names in there, sectors like industrials and raw materials, but also things like communications. The Nasdaq Composite is really more focused on the new economy names or the emerging economy names, things like communication services, technology, internet names are all, media names are all much more heavily weighted in the Nasdaq Composite than in the S&P. So the idea, generally speaking, is if both of these are breaking out, conditions are good. If both of them are breaking down, conditions are bad. Let's look at some of the signals we've had in the last 8 to 12 months. We can see that in May of 2022, We had a bearish confirmation, a confirmed bearish signal, because both the S&P and the Nasdaq made a new low. That signal was confirmed in June when both of them made a new low. Briefly gave a buy signal in August of last year, and that was when the S&P was testing its 200-day moving average. At this point, conditions started to look a lot more constructive because all of a sudden we were making new swing highs. But as we can see, that quickly failed and we went down. We then made a new low in October, which was the most recent signal. So until the breakout in February, I would argue that new Dow Theory was still pretty negative on the overall condition of the equity markets. Look at what happened in January into February. Both the S&P and the Nasdaq made a new high for the year and got above their November and December peaks. And I think that's pretty important. That's what's called a bullish confirmed pattern. New Dow Theory buy signal, thumbs up. Fast forward to where we're at this week, and you see the purple horizontal line, which is basically keying in on the February high. Now, in a lot of our videos and on my show on StockCharts TV, we've talked a lot about the 4,200 level, talked a lot about the February high and how important that is, and why we really would need to see the S&P get above that level to validate any sort of bullish thesis beyond the rally that we've seen up until the current levels. Look at what happened this week, though. The Nasdaq Composite has now gotten above its February high, right? We tested this level. It's around 12,200, 250 or so. Pulled back, tested it again in late March, again a couple times in April, and then finally here in early to mid-May, we've broken above that level of resistance. Look at the S&P, though, has not yet confirmed it. So as of now, it is not yet a confirmed signal. So one of two things is going to happen from this moment on. This is why I think the next couple days, next couple weeks could be vital for the new Dow Theory analysis. Either the bullish outcome would be the Nasdaq Composite remains above here and the S&P powers above this resistance level. It's technically around 4180, but I would look for a move above 4200, a close above 4200 to validate, to initiate that signal. If we would see that, the Nasdaq Composite stays at or above current levels and the S&P would close above 4200, that would be another bullish confirmed pattern, a Dow Theory buy signal suggesting we see strength at a time which is actually seasonally pretty weak. May does not tend to be a particularly strong year for stocks, or strong month for stocks. The alternate scenario, the bearish outcome, would be the S&P never closes above this resistance level, never closes above 4,200 for now, and the Nasdaq Composite rotates back down. If we would have that condition where the Nasdaq rotates lower and the S&P never gets above, that would be a bearish non-confirmation where one of the pillars of the economy is breaking out, the other one is not. Look out below if that non-confirmation starts to pop up on this chart. So that is a breakdown of Charles Dow's original approach of what's called Dow Theory, looking at the Dow Industrials and the Dow Railroads, how we've modernized that. Instead of looking at the Dow Industrials and the transports, I think it's much more appropriate in 2023 to look at the S&P 500 and the Nasdaq. What other ways can we use to look at confirmation by looking at different parts of the market? We can look at large cap versus small caps. We can look at growth versus value, a lot of other things, other topics which we will address in future videos on this channel. What other videos and topics and market history concepts would you like me to cover? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. I'll see you again soon.